and good evening everyone, and welcome to this results call of SBI Life for the quarter ended December 31st and also the 9 months ended 31st December. Along with me are Mr. Sanjeev Pujari, President Risk and Actuarial, Mr. Abhijit Gulanikar, President Business Strategy, and Sangramjit Sarangi, our Chief Financial Officer and Head of Investor Relations. I'm very happy to report to you that we've had again a very consistent and good quarter and good 9 months in terms of all the parameters that we have highlighted to our shareholders. It has been good on both qualitative and quantitative terms. Just to give you a sense of some of the key results before I delve a little more into details. The key during the 9 months, our individual rated premium, which is the core metric that we are tracking in terms of top line, has grown by 43.7% from 37.2 billion rupees in 9 months FY17 to 53.5 billion rupees in 9 months FY18. On quarterly basis, that is only for Q3, the growth is 38.2%. As you would know that this is the exact growth that we have been showing quarter on quarter and year on year from FY15-16 onwards. So FY15-16 we had a 39% growth. We again had a 39% growth in 16-17, and so far we have shown a 43.7% growth in the 9 months. The other good news is that we are as focused on our renewal premiums, because that is what gives us our long-term profitability, as also our short-term, long-term profitability in terms of growth in embedded value and the accounting profits that we derive. So our renewal premium has grown by 32.7% in the 9-month period ended 2017. The other good news is that our value of new business, the value of new business is the VNB, has gone up to 934.36 crore rupees. While we don't have a comparable figure for last year because we are declaring for the 9 months for the first time, you would recall that for the entire year 2016-17, we had a VNB of 1036 crores. Whereas we now have a VNB of 934 crores only in the 9 months ended December 31st. And as you would know, and as you are aware, the Q4 for our company as also for the insurance industry is the strongest. So we are very well poised to end the year on a very high VNB. Another good news is that our margins, we are focusing, and we have promised that it would steadily increase. It was at 15.4%, the VNB margin, as at March 2017, and we have touched 16% as at the end of December 31st, 2017, which again is very satisfying for us. Just to give you a breakup before I run you through some of the slides which we have kept in our presentation, which has been uploaded on our website. So on the new business product mix, the individual savings and protection business has both grown by 43% and 18% respectively on 9 months basis. And the share of ULIP in new business premium has also been rising, but we have made a balance between the share of ULIP and traditional. And we are also focusing a lot on the protection business, which has is now around 6% of our total business as against 4.9% as at the end of March, and we are focused on improving this further. The other area where we would like to focus upon and inform you, which is again very good, for 9 months ended December, our OPEX ratio, that is our OPEX operating cost ratio, stood at 7.7% as against 8.9% in the end of last financial year. This is a significant advantage that SBI Life is deriving from our core performance, and we are able to grow by keeping our operating expenses low. Our total cost ratio has also decreased from 12.6% in 9 months 2017 to 12.3% in 9 months 2018. I would like to assure all the investors that while we are keeping our OPEX and total cost ratios under check, we are in no way compromising on business costs, on whatever is required for growth in business, especially relating to compensation of growth in commission or compensating our distributors. We are growing as high as the revenue growth, which is to be expected. We are also investing a lot in future growth in terms of IT capabilities. But at the same time, we are able to keep our operating expenses low simply because we are efficiently managing the entire administration and distribution, and which is giving us a significant advantage in terms of growing our embedded value and giving more value to the company. On the qualitative front, we are happy to report that our persistency 13th month has improved from 79.8% at the same time in the previous year to 81.51%. And in the current financial year also, we have increased by about 40 basis points. We were at around 81.1% as at the end of March. Our 37th month persistency also has improved from 67.48% to 68.81%. In 61st month, we show a decline from 69 to 59, but that is only because in our regular premium, we are growing faster. But in our, we had a lot of single premium at that point in time in the previous 5-year cohort, and that has now come down because, as you know, we have reduced our single premium to around 8% of our total business. Our solvency ratio also continues to be very healthy at around 2.06 as compared to 2.09. So we are growing our business by around 40% year on year, quarter on quarter, and at the same time maintaining our solvency ratios because our profitability is flowing in very well. As far as net profit is concerned, again, this is not what we actually drive because we are focused on increasing value. However, our net profit, because of our significant growth in renewal persistency and renewal income, which has grown by 33%, our net accounting profits also have become very healthy. So in the 9 months in the previous year, our net profit post-tax was 618 crores, which has become 769 crores, a growth of 24%. And in Q3 itself, we have grown from 190 crores to 230 crores, which is a growth of 20.9 or close to 21%. So as you see, just to sum up, the core parameters that I mentioned, whether it is top line growth, whether it is accounting profit, whether it is VNB margin, whether it is the return on equity also consequently has gone up from 16.4 to 17.1, whether it is total cost ratio where we have kept it under check and reduced it, whether it is operating expense where we have reduced from 8.9 to 7.7, and whether it is persistency where we have improved gradually. We are doing well on all the core parameters and have been able to deliver another quarter of consistent profitable performance. One parameter which I had omitted to mention was the surrenders to AUM, which again gives us an idea of how much we are able to hold on to business, which is very useful for renewal. So we had a surrenders to the total asset under management of 9.1% as at the end of 31st December 16, which we have brought down to 7.5% as at the end of 31st December 17, which again is a significant improvement and which is giving us this strength to able to have a very, very profitable growth in our embedded value. I would like to keep a lot of time for you to ask questions, but before I do that, I would like to quickly run through some of the slides. If you are having it in front of you, it would give an idea of some of the metrics in which we are doing well or how we are doing as compared to what we had promised. So as I said, new business APE has grown by 42%. Even individual rated premium in Q3 has grown by 38%. In 9 months, it has grown by 44%. Renewal premium, as I said, in 9 months has grown by 33%. In the quarter, it has grown by 32%. Gross written premium in 9 months has grown by 18%. In the quarter, it has grown by 29%. Profit after tax, as I said, has grown by 24% 9 months and 21% in the Q3. We continue to grow well and are therefore gaining market share. So our market share as compared to 9 months FY17, our private individual rated premium market share was 21.3%. Year on year, it has grown to 23%. So it's almost a 1.7% market share. And as you would recall, this is almost a gain of around 7 to 8% in the last 3 years. Our total market share has also grown from 11.3% to 13%. We are also growing our number of policies, and our new business policies has increased by 16% this year. Earlier, we have also stated that our product portfolio continues to be very diversified. Our ULIP share is now at 9 months FY18 is at 59%. Our participating is at 20%, and our non-participating, which includes the protection portfolio, is at 22%. So again, a very balanced mix. Our protection growth in Q3 has been as high as 34% because we have started focusing a lot of protection. The growth in protection itself has been 34%, which I am highlighting in Q3. In 9 months, it has been 18%, and we are focused on increasing the protection mix as we go along. And in terms of channel, just to say that both our channels are firing very well as we have been doing in the past. Our banca channel has shown a growth of 45% in ULIPs and 23% in Q3 FY18. Our banca channel has grown by 45% and our agency channel has grown by 23%. In 9 months FY18, our banca channel has grown by 37% and our agency channel has grown by 26%. So as you would know, the agency channel growth of 23% in Q3 and 26% 9 months is significantly higher than the agency channel growth by any other company. And I would reckon that most of the companies are at around the 10% mark, whereas we are growing at 20% plus, and we are well poised to increase this even further in the future. In terms of the individual rated premium channel mix, again, similar figures. Banca has grown at around 53% in the 9 months, and agency has grown at around 25%. And our ticket size in banca is now crossed 60,000 rupees. In case of agency, the productivity has increased from 2,01,451 rupees as at the end of December 16 to 2,34,753 in the 9 months FY18, which is significantly better than any of the private sector players that also run an agency channel. Our operating expenses we have already spoken about, so I will move on to the surrender ratio. Surrender ratio, just to reiterate, in the 9 months FY17 we were at 9.1%. We are now at 7.5%. We continue to focus on the fact that we do not allow any kind of mis-selling or unfair business practice, and as compared to 0.20 or 0.23% last December, that is the ratio of mis-selling complaints to total complaints, we have brought it down to 0.16% this year. Very quickly on the assets under management and how our investment performance has been. So we are now at around 1,11,000 crores of asset under management. It has grown at a rate of around 23% year on year. And the investment performance is very important in terms of the ULIP fund. And the good news is that each of our funds, whether you take a 3-year CAGR or a 5-year CAGR, has beaten the benchmark index. So the benchmark index is the Nifty in case of equity. It is the CRISIL bond index in case of bonds. Before I hand over for questions to all of you, just to sum up what we are saying, we have said that capitalize on the insurance industry growth, which is doing well. But for SBI Life, I would state that we are not just dependent on the market growth, because as you would be aware that in 2015-16, we were able to grow our business by 40%, whereas the market hardly grew at around 9 to 10%. In 16-17, the market grew better at 25%, but we still repeated a 40% growth. This year, again, we are close to 40% or just above 40%, and the market is growing at around 23%. So we are repeating this consistent performance quarter on quarter, year on year, simply because the potential that is available to us, both in the banca channel and in the agency distribution channel, is very, very significant. And we are able to leverage that. Even today, while we are happy that SBI has grown, the potential that is still available in the SBI channel is very significant. We are happy that our agents have become more productive, but I think we have a significant way to go in terms of, if agency channel is growing at 23% today, there is no reason why we can't do better in future. The other thing that we have been able to do is to ensure profitable growth. And we have been able to reduce our OPEX ratio. We have been able to keep our costs down. But at the same time, we have been able to ensure that we are focused on the product mix. So while we continue to grow strongly in ULIPs, we have been able to do a correction in terms of traditional and ULIP. We have been able to do a correction in terms of the amount of protection products that we have managed to sell, and we will continue to remain focused on that. The other thing that I would like to assure all of you is that the strength of the company lies in 4 areas, and to which we are all focused. First and foremost, it is customer service, because the customer is what brings us all our value, and each and every employee in the company is focused on customers. We have brought in a new concept of measuring the net promoter score. That is the score which is given to the company by customers at any service point, and we have built it into the KRA metrics of all our employees. The next platform would be risk management, in which we have come a long way. We are using analytics for risk management in various fields. We have been able to improve our renewals because we have digitalized the process. We even have a surrender management tool. We call it SMART, Surrender Management and Retention Tool. We have a red, green, amber way of calling clients who are due for renewal. And we have invested a lot in new technology, in applications like Connect Life, through which we sell our digital in a digital manner in the assisted mode. We also are doing geo mapping, automated underwriting, and we have various processes for payment of renewal. So IT remains the third pillar. So customer is of course the first pillar, risk management is the second pillar, investment in IT is the third pillar, and most importantly, I would say investment in our HR is the key pillar on which the company's success is built, because if we are to serve the customers well, all the employees and distributors that we have are also to be supported in a reasonable manner, supported in a manner in which they can do their job. We have appointed one of the best consultants to give us feedback as to how we compare in terms of employee satisfaction and employee happiness and employee compensation, and we are focused, and all the company as a whole is geared towards the targets that we have set. So in sum, I would like to conclude here. I have taken up about 20 minutes time to highlight the top features, and now I request our coordinator to open it up for questioning, and whatever questions you have, we would, as a team, we would like to answer them to the best of our ability. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We will take the first question from the line of Narottam Garg from CWC Advisors. Please go ahead.
Hi, good evening, sir. Congratulations on the great set of results. Hello.
Thank you. Thank you very much.
Yeah. So my question was on VNB margin calculation. So this VNB is calculated on the cost basis for FY17, or is it based on the costs that have been incurred in a 9-month FY18 period?
No, it's on the cost basis of 16-17, last financial year. Because
So that
we do the analysis on a full financial year, we don't do it on a part.
So we have not taken the cost advantage that we have got this year so far. We will take it only at the end of the year.
So that advantage would not only apply to the fourth quarter of FY18 but also to the previous quarters, right?
Absolutely.
Yeah, absolutely. Yes, correct. Absolutely.
Understood.
It's applied for the entire year. So basically, it will kind of self-correct once you do the calculation at the end of the financial year.
Understood. And sir, second question on the protection business. I just wanted, if you could share data on, if you could divide it into individual protection and group protection, how much would be individual protection for us and what rate is the individual protection growing at?
So individual protection actually is not growing. All the growth has come from group protection, credit life, and the 1-year term that we sell to the groups, affinity groups or to employer-employee groups.
Understood. And is this linked to, I also see that there is a rise in the corporate agency partners. There is a 33% increase. So the credit life pickup is linked to that, is it?
No, credit life pickup is mainly through SBI only.
Understood. Okay. Thank you so much, sir, and all the best for the full year.
Thank you very much.
Thank you. We will take the next question from the line of Avinash Singh from SBI Cap Securities. Please go ahead.
Good evening, sir.
Good evening.
Two questions.
Avinash, you're not audible.
Hello?
Yeah.
Can you hear me now?
Yes, now you're clear. Yeah.
Yeah, hi. Hello. Yeah, congratulations on great set of numbers. Two questions. First on, again, on protection. We were supposed to launch some new protection product on the individual side to make our pricing more competitive. Have we done that? And if at all, what sort of, changes we are bringing so that our pricing is competitive, still protecting our profitability on the individual protection side? That is one. And the other part of this protection only is that we had sort of a surge in group protection premium in FY16, particularly on that Pradhan Mantri Jeevan Jyoti Bima Yojana. So what was the experience there, and why has that sort of a product now not growing, or in fact it has been degrowing for the last 1 year or so? So that is on protection. And second question, not related to this 9 months. In fact, it's related to the for Mr. Pujari, the tax sensitivity of VNB. So in our case, the VNB margins in a hypothetical scenario of tax rates going up from 14.45 to 34.61% is 36%. So that appears a lot higher than the peers, and in fact, it appears higher than the tax rate changes. So if you can just shed some color on that. These are my two questions. Thank you.
So I'll take the first question on protection and ask Sanjeev to take the next one. So on the protection, number one is we are growing our group term insurance. So we have almost, other than credit life, where we are trying to secure a more higher penetration in SBI, we have grown our group term insurance business by almost more than 100%, in this quarter, which is along with various companies, to whom we directly approach and get business. So that is what we focus on. The other one is you talked about the launch of the product, which we have in fact done just 2 days back. So this is a product called Purna Suraksha. So Purna Suraksha is a very good individual product where we are proposing a product where it is a rebalancing between your life cover and your health cover. So if you come in at say 40 years old or 35 years old, initially you will have say 90% for life cover and 10% for health cover. And then this will progressively change, and after 10 or 15 years, the health cover automatically increases. So this is something which is desired by people. We had done some feedback in the market. Just to give you a sense, individual protection is difficult to sell in India for two reasons. One is there is a lack of demand from the customer if you give him only a pure life cover. So this product takes into account people are concerned about health, so that will be one thing taken care of. Second, the premiums tend to be lower and consequently the commission also tends to be lower for the distributors. So what we are planning in this is we will not sell it in isolation but in combination with other savings products, and we are very, very hopeful and confident that this is one product which will help us to even ramp up and leverage our protection even on the individual platform. While in the group platform, we are very confident that we will continue this steady march of increasing protection, but we will be able to do it even with this product and a few other products which we might consider in future. On the tax front, before handing over to Sanjeev, again, I would like to give you a very simple fact that if you were to calculate at 34.5%, you're calculating based on a hypothesis that that is likely to be the increase, which it may or may not be. We had highlighted that during our IPO as a risk factor to be kept in view. It does not necessarily mean that it will come. My sense is that we do not expect our VNB to be significantly different on the impact of tax on our VNB to be significantly different from that of any other company. So if we have highlighted something which is more conservative, it is because we wanted the market to know that we are a company which is more transparent and conservative. That is my take, but I would request Sanjeev to add to this.
Yeah, it's slightly technical, but again, I'll try to explain to the best of my ability. Hopefully, you'll understand that. See, when you are looking at VNB, I'll talk of VNB only. FCEV, the EV part, I'll leave it out because that's a lower rate. There are two components to that. On the positive side, you have the profits, basically. So that is the gross profit which you are discounting on the positive side. And there is a negative side, which is the reduction, which is the reduction for capital. Which is the frictional cost of risk capital, which is essentially your capital outlay. On that, there is an investment income, and then you are taxing that. Now, both these things operate in two different ways. Now, on the positive side, what happens is the net effect of moving from a 15% to a, say, 35 or 36% is from moving from a net tax of 85 to a 65, which essentially, if you calculate, it will be around 24%. Right? So instead of getting a net of 85, after a 15 deduction, we are calculating at 35, I'm getting 65. So essentially, that is a fall of 25%. You would argue that why shouldn't the fall be only 25%? Now, the answer to that is when you see the deductions, there the tax applies in a very positive manner. So it's the capital, the return on the capital, and then you are taxing that and then deducting it from the gross profit. There what happens is, the way it applies is, it moves from 16 to 35, which is essentially a 150% rise. So essentially, if the deduction was 10, hypothetically, then it becomes 25. The impact of that is big. So basically, it pushes the impact of tax from a 24% to roughly, in our case, it's around 34 or 35%, if I remember correctly. For other companies, it's lower because of, my speculation is that, because the capital they keep aside, basically their internal norm, we take 180% of the solvency ratio. I know for sure, I don't know about SDFC, they take 150%. So basically that could be the effect which would explain the marginal difference in the impact of taxation.
So just to sum this up, we always believe in giving you very frank and transparent answers, which Sanjeev has done. But again, you have to look at it holistically. I think we are picking on one or two points which have yet to emerge because there are so many things which will have to be played. And if the insurance industry is something which is being supported by the ecosystem for various reasons, I am quite sure that, and it is a very important social security measure. So when the various changes are brought about by the government, and they will be brought about in a very, very calibrated manner, which will not disrupt this growth. And I think, and to put it very mildly, I don't think SBI Life would be any worse than any of the other companies with whom we are competing. I think that we should not look at these issues in isolation, but yes, we should definitely keep the risk factor in mind. But I would like to just give you some sense of reassurance on that, because
I mean, at this point of time, it has to be looked at only as a sensitivity parameter.
Absolutely.
Exactly. That was my question. I mean, I am not speculating in credit. I just wanted to understand technically. A quick follow-up on that credit life. We have been selling some regular premium rather than single premium on the credit life. What has been the experience or persistency experience in that?
It's around 90%, but just to give you an update, it is 90%. But just to give you an update, from December of 2017, that is about a month back, in consultation with SBI, we have shifted to a single premium mode in credit life also, so that we now have 100% persistency in that.
Thanks. Thank you.
Thank you.
Thank you. We will take the next question from the line of Ridhima Saxena from Bloomberg Quint. Please go ahead.
Hello, sir. Congratulations on great results.
Thank you.
Sir, my first question is related to non-par variable products, for which I think the net premium has reduced by nearly 60% on a year-on-year basis. As well as for non-par individual life and pension products, we've seen some degrowth as well. Could you help us understand why that is there? So that is question one. The second is around single premium. So is that a conscious decision, and why has the shift happened? Then what is the real ratio between regular and single premium policies that is there now? And there's also reduction in group premium for fund management. So what would be the reasons for that? So these would be my three questions, sir.
Yeah, so I'll start off the answers, and I'll be supplemented by my colleagues. So first is, the non-par and the last question that you asked are related. So the non-par that we had, last year, so if you recall, our total new business premium in 2016-17 was 10,100 crores. And of which 2,700 crores was group fund management. So it gave us almost a 27% share of group fund management, which is now down to around 11 or 12%. This is a conscious strategy because we have been feeling that over a medium term or long term, this is a very volatile segment where you can get business, not get business, and even the profitability is very volatile because, you have to set it in line with the interest rate expectations of the customer. So we have a target of keeping it at around 15 to 18%, and we are in line with that. So that is one reason for both the group fund management and the group savings correcting. As far as single premium is concerned, the entire value calculation is done on APE or rated basis, which takes in 10% of the total business. Right. So at 10% of single premium when accounting for it. So our view has been that if that be the case, then we should keep our single premium at around 10%. So if you were to follow SBI Life's journey, then around 4 or 5 years or 6 years back, we used to have as much as 25 to 30% single premium, which made it a challenge for us in various ways. In the last, say, between 2013 to 2015, we were hovering at around between 15 to 18%. And currently, from last year onwards, we have brought it down just below 10%. So the instruction that is given to the field is that we will try to keep it at around 10%. Right now, it is at 8%, and we are comfortable if it stays at between I would say 8% to 12% range, which is for the medium term a very satisfying proposition for us. So that's any supplement?
No.
Yeah.
Was there another question?
You had some other question?
Yes, sir.
The answer?
So one last thing on ULIPs. You've said that you would like to have a stable ratio, but currently ULIPs contribute to nearly 60% of the premium income. So how do you plan to reduce it, and what would then be the ideal proportion of products in your portfolio?
Yeah. So what has happened this time is that in our quest to reduce the group fund management that was at the non-par segment, we have in the first 9 months brought it down very, very significantly, even below our target. So as I said, our target is to keep the group fund management at around 15 to 18%, which we are likely to reach by the end of Q4. So ULIP will automatically adjust to around anywhere between 50 and 55%, 52% or so, which we had last year. Last year, if you recall, we had 50% ULIP, 13% par, and the rest was non-par. So we are likely to have slightly more par this time. ULIP would be at around say 52, 53%. Par should be at around 20%, and 25 to 27% should be non-par, of which we hope that around 6 to 7% would be protection.
Correct.
So that's
Thank you.
the overall mix that we are planning, and we are reasonably confident that we will achieve it by March 18.
Thank you so much.
Thank you. We will take the next question from the line of Rahul Marathe from Akash Ganga Investments. Please go ahead.
Hello. Congratulations on good set of numbers.
Yeah.
I would like to know about the guidance for growth rate and VNB margins.
Okay, so guidance is something which we would normally like to avoid, and basically request you to look at our past performance over the last 3 years. But I will give a general guidance based on our performance. So we are very confident because, as I was explaining to you, 15-16, 39% growth top line. 16-17, 39% growth top line. 9 months FY 17-18, again 43% growth top line. So there is no reason why we should not achieve that at the end of 17-18. That is the first guidance that we are giving you, that we continue to be consistent and repeat this. And if we are doing it based on the potential that is available in SBI and the agency channel, we are very confident there is no reason why we should not be able to repeat it at least for the next few years. That is 18-19, 19-20 and 20-21. That is the 3-year internal projection that we are doing. On VNB margin, again, if you look at what we had said during the IPO, that we will continue to deliver steady growth in VNB margin and the VNB itself, and which we have delivered in the 9 months. So we were at 15. Let's start with when we disclosed our EV for the first time and VNB for the first time. So we disclosed it as on March 16. In 2016, we had a VNB margin of 14.2 as at March 16. We improved to 15.4 as at March 17. While I know many analysts had said that we might reach 16% by the end of March 18, we have already reached 16% by the end of December 17, and Q4 is always the best quarter for us. And as we answered in the first question, we have not done any assumption change, and all the assumptions that go into the VNB, including costs, etc., are to our advantage. So VNB margin also, we are going to have a steady improvement, and this improvement will, the only guidance that we can give is we are very, very focused on improving the margin in all our products, the product mix, not only protection. We are even looking at other products. You can make some difference in your margins in the way you distribute your other products also. So we will grow protection, we will grow and mix our margins in a way that we will continue to show very good increase in VNB margin. But most importantly, I think what we have promised to analysts and to the market is that we have seen a return on EV growth in the first 2 years of disclosing EV of anywhere between 20 and 25%. And we have not been able to disclose. From next year, we will try to do it. The EV as on December, because we don't have the mechanism to calculate it so fast. But we had disclosed an EV growth of 20% in the first half, and based on the VNB, you can guess that the EV growth has been even better in the third quarter and will continue to be so in the next quarter. So EV growth, we are clearly promising something which is the best in the industry, and no other company is showing an EV growth. And to my mind, margins should certainly improve to enable us to help us achieve that. But at the end of the day, it is the return on EV, which we are very, very confident that we will continue if we have a growth of around 40% in top line and have this kind of persistency, renewal and cost advantage, and with the kind of margin improvement that we are seeing, the EV growth will continue to be anywhere between 20 to 25%.
Sir, so what would be the ROEV for the 9 months?
So 9 months, as I said, we have not disclosed, we have not calculated. We had actually taken a call to disclose EV only at end of 6 months this year. Next year, we will try to do it on a quarterly basis. So we have not disclosed the EV, so we cannot tell you what is the growth. But we are only saying that you look at the VNB, the improvement in the margin, and the EV growth you can extrapolate. And in the first half of the year, as you know, we had an annualized EV growth of 20%. Third quarter has been significantly better for us, and fourth quarter is likely to be always been a good quarter for SBI Life. So the EV growth that we will have this year, the only guidance that I can give you will be anywhere between 20 to 25%, which is by far the best in the market if you compare any company which is there in the industry.
Sir, one last question, sir. What would be the penetration of banca channel going forward?
By penetration, how would you define that? Number of branches active?
Means number of branches presently and how it will be increasing.
So number of branches, actually, if you just take minimum number of policies being sold, just one policy of 25,000 rupees per month, then we have around 62% activation this year. This used to be significantly lower earlier, but as you can understand, one policy sold per month of 25,000 rupees is a very small measure for most of the SBI branches, which have 75,000, 80,000 customers. So we have some internal benchmarks which are much higher, and even by those metrics, we are steadily improving. Just one statistic I can give you, the premium that we collect per branch, when we take the average of all SBI branches, currently is 18.5 lakh rupees. This used to be 7 lakh rupees 2.5 years ago in 2015. 2015 March, we had around 7 lakh rupees. This has now become 18.5 lakh rupees. And the way to go is that we feel that there is scope to take it up to even 35 to 40 lakh rupees, and which we will not achieve in 1 year, but we will be having a growth of maybe 45-50% over the next 2 to 3 years to take it up to that level. That is the potential which is available in the banca channel. And agency channel I had already covered, that we have an agent productivity currently of 2,34,000 per agent, and which was 2,01,000 in the previous quarter, and which is significantly better than any of the other private sector players.
Okay. Thank you, sir.
Thank you.
Thank you.
Thank you. We will take the next question from the line of Anand Jain, individual investor. Please go ahead.
Thanks for the opportunity, sir.
Thank you.
So my question here is mainly on EV and our yield assumptions in EV. What I wanted to know is that, when determining EV, where do we get these yield values from? Are they from the Clearing Corporation of India?
So there, we have got two choices. One is the FIMDA, other one is the...
Hello?
That is what we have done when we disclose the EV.
Sir, I'm sorry to interrupt. You're not audible. Can you please repeat?
Yeah, so I just wanted...
FIMDA.
So there are two choices which Sanjeev had mentioned. You can either take the FIMDA yield curve or the CCIL. We have, as disclosed in our prospectus, we have taken the FIMDA yield curve.
Which yield curve, sir? Can you repeat that?
FIMDA. That is fixed market, fixed and money market
derivatives association.
So, if I were to use the yield curve, then, the assumptions that are there in those yield curve are like, 20-year yield is like around 7% assumptions. These kind of assumptions, roughly around 7% is where they are. So when I look at that yield curve, FIMDA yield curve, so on the EV side, when I'm making my embedded value, if a and we have seen in the world, even in the developing countries, that the yields have gone really, really low. I mean, to a point where they have gone below zero. So how are we placed in terms of, these kind of estimates when we do? I mean, we do have a sensitivity analysis for 100 BPS or 200 BPS, but we have seen the interest rate go really wacky. So how do we have, an assessment of that kind of situation?
See, you don't have a choice in the first place. You have to go by the market yield curve, something that has been scientifically calculated and validated. So obviously, you have to go for the yield curve. You have the yields. What essentially we do is that we take the spot rate, convert that into the forward rates, which gives you the year-by-year rates. And any yield curve that you take would, go up to 30 years, essentially. After that, if there is any liability on your book, then obviously you need to extrapolate. So we take the last, forward rate and extrapolate that. But again, this is what the market gives you in terms of its overall estimate of the interest rate, and then very objectively you have to use it. All the companies use the same. I mean, similar yield curves, essentially.
No, I agree with you. I mean, is there a way? I mean, I've seen
200 basis points is difficult to say. If interest rates go really low, we can't really say what would happen. Then we will have to assess at that point in time. In fact, in recent past, we have seen yields have actually gone up and not gone down, at least in India.
No, I agree that. I agree to that. But when we are looking at insurance, we are looking at not like, a year or 2 years or 6 months. We are looking at really 10 years, 20 years down the line. And specifically when EV actually has that component. My second question is on the liability side. So on the liability side, if I were to take all the three companies or even the four, if I were to include LIC as well, HDFC, ICICI and SBI, why do we have different assumptions regarding inflation?
Different assumptions regarding inflation. It could be different because, see, almost half your inflation comes from your, the employee's salary growth. So your market assessment of inflation would be very objective. But again, internally, you'll have to factor in your salary growth, which goes into, the market-related inflation that you arrive at. So to that extent, possibly, your inflation rate would vary from company to company.
No, but the difference is so huge that ICICI has a 420 basis point, 4.2 as inflation assumption, and LIC has around 7 to 8% inflation assumption. So
it doesn't use inflation for the EV calculation. LIC would use, I don't know where do you get the figure, but again, they would use it for the statutory valuation only.
Okay, so the last question again
on the market consistent inflation calculation.
Again, the last question on a similar side is that even if I were to look at comparable products, on the participating and on the protection side, the assumption on the liability side in terms of the yields on liabilities is again quite variable across companies. I mean, it kind of makes much more sense to be at least more conservative in terms of liability side yield assumptions. But what I see is that ICICI is doing a relatively good job in being conservative and saying that, our liability side yield assumptions, as declared in L41, is way lower than, our assumptions, or for that matter, assumptions by other companies. And why is that again coming there?
I think you're referring to here the statutory valuation of liabilities. We are not talking of the embedded value here.
No, I'm not talking of the embedded value. What I'm talking of, actually, it is in kind of sense comes into, because your net worth would be defined by your yield assumptions on the liability side, and when you're selling a product to the customer, there is an yield assumption there that you're going to give to the customer. So my question, and that would in the kind of profits that you make would anyways fall into your PAT numbers and net worth numbers. So in some ways, it is related to EV. But
again, you see, overall, it won't make any difference overall. Only thing is your bifurcation between net worth and future profits would be different. But again, NCEV in total would be very similar, because whatever you don't take as, if you are conservative on your statutory valuation, your net worth will be less, but again your future profits to that extent you will compensate, because you are discounting and accumulating at the same rate. But again, going to the statutory valuation rates, statutory valuation, the yield would depend on the inherent assets that you have to in order to back your liability. So, for example, LIC, I'll give you the example of LIC. LIC would be holding, particularly for their par fund, relatively older securities, which they purchased 10 years, 15 years back, which possibly would still be there if they're holding 20, 25 years, 30 years yield. So it's a book value of yield which goes into the calculation rather than the redemption yield, the market yield. So to that extent, they would be able to kind of stick to a higher yield for a longer period. Assets which are purchased recently for the new companies, obviously you'll have to go for your yield will be lower. Apart from that, if it is a participating policy, then your approach to bonus declaration would also decide what you take as a valuation rate. To that extent, possibly you can be a little bit prudent, you can be a liberal in the sense that what kind of bonuses strategy you adopt for your participating policy. So to that extent, there will be variation. I don't think we can rule that out. But again, as far as the impact on EV is concerned, it won't be significant, whatever be your basis for liability calculation.
Okay. Thank you, sir. Thank you.
Thank you. We will take the next question from the line of Abhishek Saraf from TBS. Please go ahead.
Yeah, hi. Thanks for the opportunity. Sir, a few quick questions. So first of all, on the branch activation, so you said that around 62% of branches are now selling one policy per month of around 25,000. You also disclose that on more like 5 to 6 policy a month, so which is more critical mass. So that used to be around 30% of branches used to sell 5 to 6 policy a month. So sir, how has that improved over the period? That is one question. And sir, on Pure Protect, I just wanted to understand a bit more in detail in terms of, you said that in the group Protect has increased by 100%. What has been the trend in the credit life segment and also in the individual Protect? And what could be possibly the break, if you can also share the breakdown of these three products in the Pure Protect?
So breakdown, so one by one, credit life, the activation. So branch activation, see what will happen is 12-month number will be higher than 9-month number, because you will know that our business is little seasonal, and you will get 1, 2, 3, 4, 5 number which is higher than 30% by end of the year, a significantly higher number than 30% by end of the year.
Currently, how much is it?
So it will be about 31, 32%. December, I don't have that exact number, but it will be about 31, 32. But that number will be significantly higher by the end of the year. When you will look at, we will disclose, the similar number. As far as credit life is concerned, it is growing by about 10% in the current year compared to last year. Individual business actually has not grown at all. And the group protection, as we said, has grown by 150% for the current financial year.
So I can give you, some figures on this as at the end of December. January these have substantially improved, but since we are discussing December figures, so on credit life we have grown on rated basis from 129.8 crores to 143, which is a 10.3% increase. In GTI and group others, we have improved from 50.4 crore rupees to 123 crore rupees, which is a 144% increase. And PMJJBY is a small amount, and there was another question related to this by one of the previous participants. Now, PMJJBY is not something which we drive. It is something which the banks have to sell. So it does not fall part of our core strategy. So therefore, we are not able to take this up. But coincidentally, there has been a small increase. So we have grown by about 48.7% overall in group protection from 188 to 280, which is fairly significant. And as I mentioned, as reply to one of the earlier questions, that individual protection, we are almost at the same level, but this is something which we are now focusing on significantly, and where we are very confident that this will also pick up because of the way in which we will be selling this product to the customers and making it a good value proposition for them, either individually or in combination with another savings product. So roughly that is the thing. Two key elements on protection. One is GTI and group others, we will continue to focus because it is giving us very good traction now. Credit life, the growth is only 10%, but our penetration within the SBI fold has increased significantly from around 35% of home loans covered to about 48% now. But what has happened is that the new disbursed loans in SBI this year, although SBI, as you know, is now the largest home loan provider, continues to have a huge lead over HDFC and HDFC Bank put together. But still, the new disbursed loans this year have been marginally lower than so far. But we understand that SBI is also seeing very good traction in disbursement of new home loans right now. So we expect this figure to go up significantly by the end of March. And going forward, these three will form part of our strategy. A combination of protection and savings in the individual platform, credit life, increase penetration significantly in SBI and look for opportunities in some of the new tie-ups that we have. And GTI, where we are now getting significant traction, we want to ramp it up. Maybe we may not get 144% growth year on year, but certainly we should keep getting 40 to 50% growth in the next few years on this.
Okay. And sir, one small question on the margin front. So effectively, you said that you have still not taken the benefit of cost as yet. And so, if I just did doing a back of the envelope calculation, it seems that while your 6 month was 15.6 and 9 month was 16, but if I try to do a quarterly basis, so effectively your the third quarter FY18 VNB margin comes to it around 16.8%. So I don't have the quarterly breakdown of earlier quarters, but it seems that on a quarterly basis it's quite a big jump, and this coming without even taking into effect the cost benefit. So is it largely attributable to your product mix, or has there been any improvement in the duration or the premium payment terms? And if you can just dwell a bit on how the duration is also improving in terms of your products.
No, we haven't actually done any analysis on why it has changed to the extent it has changed. I think it's just 30 basis points. But again, the factors which we could attribute, maybe a little bit of change in product mix. Yes, obviously, product mix would obviously change from quarter to quarter. The yield curve, obviously, the only thing that has changed in the calculation as far as the assumption is concerned is the yield curve. So, it was a September yield curve, now it's a December yield curve. Obviously, there has been movement, so it's an impact of that. But I don't think there is anything else which has, impacted the VNB margin. So these two. So whatever movement would be attributed to these two factors.
Okay. So is my assessment correct that 3Q would be 16.8%?
So we haven't done a quarterly assessment, but it would not be fair to pin it down because we have calculated on a 9-month basis. But all that we would, I've spoken a lot about the VNB margin and the way we are looking at it. So what we are saying is that if we continue to grow our business, even with the kind of product mix that we are having currently, this would show a steady improvement up to a point, and we have 14.2 became 15.4, 15.4 has already touched 16, and it would probably go up to a higher figure. And one more year down the line, we would probably see an even higher figure. But add to that, you also have to look at the product mix change, which we are driving. And there also you can already see, we can discern certain significant changes in protection being given more focus. So with that, and if we are able to get that successful, we are very confident that since we are able to deliver on most of the other platforms, we hope to be able to deliver on this. But, from the management side, I think what we like to provide guidance is on what we have already achieved, rather than, promising something which has not happened. So to cut the story short, we are very confident that margins would improve, and it would improve significantly, but we should not, or we would not like to get pinned down to a figure for either Q3 or Q4.
No, and just to tell you, suppose we are increased, the margin will increase because interest rates have risen, correct? So when I apply September interest rates and when I apply December interest rates, the December interest rates will apply to all 9 months business. So you can't say 16.8 for one quarter.
Fair enough.
So, it's unless you do full analysis, putting numbers like that would be slightly dangerous.
Sure. Got it, sir. Thanks a lot.
Thank you. We will take the next question from the line of Kunal Shah from Edelweiss Securities. Please go ahead.
Yeah, hi sir, this is Prakhar from Edelweiss. Sir, a couple of questions from my side. First is in terms of protection. When we talk about protection, is the pricing key driver of the protection growth, or a brand or something else which is driving the protection business?
So both pricing. See, it is pricing plus brand. Both have to be in place. Otherwise,
pricing, brand, and I will also add effort. As of now, I think we have also understood that our company is virtually delivering on all fronts. We are way ahead of the others in terms of increase in market share. We are way ahead of others in cost. We are improving our persistency. We are delivering on all service metrics. So then what is it that the analysts and the market is looking at? So we understood that while we have a very healthy ratio in terms of new business margin and our EVs are growing, they are looking at even better improvement in the margin. And that can very clearly come if we increase our protection mix. So from that perspective, we are driving this improvement in protection, and pricing is important, but there is no point in driving protection for the sake of protection. So if you do it at a loss, then your margins will not improve. So I can show a 25% improvement in protection by pricing it way below. So it has to be, when I say pricing, it has to be a good pricing, but the right pricing. So in pricing, for example, we have reduced our individual protection pricing by anywhere between 15 to 25%, depending on the age of the customer. We are still not the cheapest, because if we were to become the cheapest in the industry, we would be at a loss. So we will clearly not do any business which is not yielding us reasonable traction. Brand, of course, is important because SBI brand stands for transparency and consistency to deliver to the customer. We have to protect that. But the third element is what we are now really focused upon, is to bring consciousness in our sales teams that protection has to be a core part of your growth. Just to share with you an internal management strategy that we have already started driving from Q4, and which we will have as a major metric, is that we will put our value of new business growth and our sales team's ability to grow protection as part of their overall sales target as a key metric in the KRA. And we have seen that whatever we drive through KRA gets easily spread as a culture within the company, and it gets delivered. So it is a mix of all these three things. It is a mix of the pricing, the right pricing. It is a mix of the value that the brand has, and the mix also of the efforts that we have to undertake, because we can have a very good price, we can have the brand, but unless it is driven, it will not yield results.
Just a follow-up on that, we have reduced our pricing on protection by around 15-20%. So across the time horizon, if I look at maybe a year back, has protection margins squeezed in for a industry as such, or it continues to be at a similar levels?
We reduced our price because we had the width, the spread to do that, because our prices, the premiums were pretty high compared to our competitors. And then the experience was also good. But again, we had to wait for 3-4 years for the experience to really bed down to be able to lower our price. Any price reduction obviously reduces your margin. But again, essentially it's a balance between whether you want still to be competitive in what you offer, particularly to the retail customer. When it's other type of customer, it's possibly fine. But again, to a retail customer, obviously the price is very sensitive, and the volume would depend on what price. But again, at the same time, you need to protect your margin. So as said earlier, we are not the cheapest, but again, we are selling at a price which we feel we would be able to sell substantial volume. At the same time, we will be able to protect our margin. And that is the thought behind the reduction in the price.
And we will not react to every change made in the market. So as Sanjeev was explaining, so one of the key drivers for this change was not that we were priced higher. That was clearly a consideration, but the more important consideration is that now we had about 4 to 5 years experience on this term product, which was very good, and we thought that we have a spread which is much higher than the margin that we will in any case get even after reduction of this price. So the margin will be still very, very healthy, but we need this kind of margin to be able to show that protection business is also very good for us.
And sir, one more question from my side. What explains this drop in 60% persistency? I missed the opening remark.
So actually what happens, so this is a cohort. So this is basically calculated on a rolling basis. So when we are giving you 61st month, it basically means these were policies sold up to November 2012, right? So 1 year, which has now turned 5 years. So in that period, 11-12, which is now the 61st month cohort, the amount of single premium which was sold as part was significantly higher. It would be in the range of 30-35%.
So just to tell you, if you had looked at last year and this year comparison, so November 11 cohort had 50% single premium. November 12 cohort has 22% single premium. So that explains the drop in persistency in the current year for 61st month. From 50% single premium to 22%.
So just to explain, single premium is automatically fully persistent. So 50% single premium would mean that 50% of your policies are 100% persistent, and then the balance 50% adds to your figure. Whereas for this cohort, it has come down to 22% single premium and the remaining 78%. So if you take only the regular premium component, that is in 11 cohort you had 50% regular premium, and in this cohort you had 78% regular premium. In the regular premium we have a better persistency after 5 years than we had for the previous year. So this is something which is good. Actually we are not very concerned about it, but even this 59% is significantly higher than any of the other 3 companies. So in 59 months, 61st month, 49th month and 37th month, we are better than our peers, the top 3 peers in the market. It's only in the 13th month that we are improving, but improving slightly slower than our peers, and we are now focused on seeing that this 13th month persistency also goes up.
So then, but this cohort change will ideally persist for next year or so at least, because if I go by FY13 numbers, then probably single premium was which was at a higher level in FY13 as well. So if that holds true, then probably that will remain. This 61% persistency improvement will not hold true for next year or so at least.
No, it depends on what was the cohort. So I think this 22% held for 2-3 years. I think even when, so I can relate because I've been in this company for 4 years. So when I came into this company, it was also at around 18%. So this 22% changed to 18% and so on, held on for quite some time. So 22 would become probably 20. So next year you should not be seeing such a change, number one. Number two is we are significantly improving on the regular premium, the collection after 5 years. So as I said, our surrender to AUM is as low as 7%. So the surrenders we are controlling, our net new cash has gone up. So you will not see a decline, and we should be able to show an improvement in this parameter also.
Okay, thank you so much, sir. That was all.
Thank you.
Thank you. We will take the next question from the line of Vishal Rampuria from HDFC Securities. Please go ahead.
Hello.
Yes, please.
So good evening, sir. So one query, basically, within the individual business, how much would be our share of direct business?
Direct business.
We have very insignificant direct business. It's very low. We only sell through the online channel, and there we are this year. So we have only 2-3 products. One is a protection product, and one is a ULIP product. So the ULIP we have sold less this year. So the protection has reduced, which is getting repriced in January. So you would see that going up. Only ULIP grew there, but it's a very small. Very small. It is one. We don't have a physical person-to-person direct channel for individual business. We do have a significant direct business, but that is all group. In group, we have a lot of direct business. Correct.
But any focus from the company side to focus on getting direct business? Because if you look at all the private players, typically they get around 10 to 15% of individual business through their own source, through your direct channel, and therefore you can easily save on payouts of commissions.
So what we are largely doing is the leads or cross-sell leads or upsell leads are given to the same channel from which business oriented.
So there is a significant amount of sales which happens through the banker channel and agency channel, which are sourced from internally.
Correct.
And why we do that, you don't save on cost. So all the direct channel, the costs are much higher. So which is why we have a lower cost ratio than any of the other companies. If what you are saying was true, then all our competitors would have had those who have a significant direct channel. Direct channel, the costs are not seen in form of commission, but there are various other costs which are incurred to get that business. And at the end of the day, we seem to be better off because we are now having a cost ratio advantage of almost 4 to 5% over the other players. So as a strategy, we will not significantly change, except that the online channel we would like to activate. There also, online channel is partly direct, partly we operate through web aggregators where there is all kinds of different issues come up. And what we are focused on is approaching through various platforms. So we have, as somebody was mentioning, and he has seen that there is a 33% growth in our number of channels which we have, number of partners which we have activated. And we are getting very good traction from 2 new bank partners, especially from South Indian banks. And we have, it's a small beginning, but we are almost on target with what we had proposed for this financial year. And similarly, we are proposing to tie up with many more who are in the market.
So second question is on your group credit business. So you mentioned that for 9 months you have clocked the rev premium of 143 crore, right?
I gave some figures. Yes.
How much of this 143 crore will be from SBI network or SBI branch?
Mainly direct. And
mainly through SBI, right?
No, direct. Direct and through some brokers, insurance brokers.
So this part is, I'll give you this.
No, you're talking about GTI, right? Not Credit Life. Credit Life is almost entirely
No,
SBI.
I'll give you the figures again.
Yeah.
Just 1 second. Okay. I switched the page. So the figures are, just to repeat, we had Credit Life, which is almost entirely SBI. 129 crores in 9 months has improved to 143 crores, which is 10%.
Yes.
SBI and group others had improved from 50 crores to 123 crores, which is 144%. This 123 crores is zero SBI. This is entirely from others. Either directly we have approached companies or through brokers.
Okay.
Significant
And one query on group credit again. So are we only selling home loan products, or we also sell for personal loans, CV loans, auto loans?
Home loan would be small in this. There is a small component of home loan, but most of it is basically group term insurance.
Employers basically.
No, sir, I was asking about the group credit business.
The Credit Life will be largely home loan, but we also think through education loan, personal loans is also sold, but that because the amounts are smaller and terms are
85% would be home loan, and 15% would be other loans.
Okay. And so also on the call you mentioned about that, so you live right now it is around 60% plus, and you mentioned that this will come down to around 50% or so. Can you again explain why you think that it will come down to 50%?
So just to bring you back, so if you remember our March 17 figure, ULIP was 50, right? Participating was 13, and the remaining 37 was non-participating.
Absolutely.
Right? So now this 37% of non-participating, around 27% of this, 27 out of this 37, not so as much as 2,700 crores was group fund management.
Yes.
So now that group fund management has decreased to about 12% of the total business.
Correct.
So as a consequence, the non-participating of 37% has significantly reduced to some figure in the non-participating is now 22%. So this 15% decline that we have had is entirely on account of group fund management going down. So if one side goes down without even a consequential increase in any two of the other sides, they will automatically go up. So ULIP individual is almost entirely sold on the individual platform. In the individual, ULIP has declined by about 10%. But overall, it has gone up only because the decline in group fund management has been significantly higher. So what I was explaining was that in Q4, we are expecting this group fund management, which is now below our annual target, significantly below our 9-month target also. So we want to keep it at anywhere between 15 and 20%. So it will be around 18%. So when this again goes up from 12 to 18%, automatically the ULIP will correct. It may not become 50, but it will be somewhere around 52, 53. And we are fairly confident that this will happen because we have already seen the month of January and the business in the pipeline. So we are fairly confident that this will emerge as at the end of March 18.
So in terms of ticket size for ULIP and PAR, if you can give me?
ULIP ticket size is we have given, so it is now 83,000.
Around 90.
Sorry, how much?
90,000.
Traditional is around 40,000.
ULIP is around 90,000. Traditional is around 40,000. So ULIPs are, as is to be expected, primarily being sold to the affluent class, and we are happy with that because we are positioning ULIP as a method of reaching out to the the people who can afford it and for whom it is the right kind of sale to make. And the traditional products are being sold more to the middle income and those who do not want to take the risk of investing in the market, whether it is debt or equity.
Okay. But in case we are increasing our the contribution of PAR in overall business, does it also mean that the growth can also come down? Because ticket size is smaller, or almost half.
So you have to see the results. So we have managed a 44% individual rated.
Yes.
By increasing the PAR from 13%, or in absolute terms, PAR savings has grown by a phenomenal amount.
Yes.
So it has been done. We know that it entails a certain correction, but we felt that given the nature of SBI customers and SBI Life customers, we should do the right sales, and it has in no way impacted our growth. So if you see the results, we have, in spite of correcting the ULIP growth and selling more of traditional, we have still managed a 44% growth. So that has not been impacted.
And one query on your margins to Mr. Pujari. So this increased margin of 60 bps only because of the yield change. So basically, the yield has gone up over the last 7-8 months.
Because that has changed. Whatever that change is. So we have not studied the impact. So it will be interest rate, yield curve change, and mix.
Product mix has also changed. What we are trying to say is that in Q3, we have not so far made an assessment on what has led to this improvement, except to state that this is in line with the general trend that we had expected, and we have not changed any other assumptions, which we can't do in the beginning, in the middle of the year. So we will make that assumption change relating to cost and experience only at the end of the financial year, which should help us to have a very healthy margin as at the end of the year also.
So those change will come in the fourth quarter, right, for the full year?
That's right, fourth quarter and for the full year.
Okay, sir. Thank you and all the best.
Thank you very much.
Thank you. We will take the next question from the line of Manish Shukla from Citigroup. Please go ahead.
Yeah, good evening and thank you for the opportunity. First, on Credit Life, what would be, on the stock of business, what would be the mix between single premium and regular premium business?
So home loan is largely regular premium. Other products are largely single premium.
So as of now, majority is regular premium, where we even have a more than 90% persistency because most of these players are SBI, most of the customers are SBI customers. So they give an fund transfer mandate at the outset, So we normally don't have any issues. However, as I mentioned at the outset, we have taken a call to change this to single premium from December. And so
on an incremental basis, the entire home loan Credit Life will be a single premium product, right?
So you can say that from 1st April, there will be no regular premium in our book.
Correct.
Okay, 1st April, there will not be a
Credit Life.
Book of business.
Yeah. So to that extent, there will be that adjustment in
so you can expect
gross premium and APE.
10% improvement in persistency because what it effectively means is we have 100% persistency.
Correct.
in credit.
So when it comes to margin calculations, VNB margin calculations, there will be two impacts, right? One will be the persistency and one will be the denominator effect in terms of APE.
Absolutely.
Right? Will that impact be meaningful in terms of overall margins, or it will just be a modest?
Be meaningful if it would be meaningful in any case, but it would be even more meaningful with what we are trying to achieve, that is improve the penetration and the growth in credit life. So this 10% also, we are very hopeful that this will now translate into a much bigger increase. Because you see, apart from it being very good for us in terms of margin, it is also very good for us in terms of our ability to sell. Because when you tell a customer that you just have to make an upfront payment along with your home loan, which is not a very high amount, he is willing to do that, and our ability to reach out to more customers will also therefore increase. So both the